Welcome back. The second part of our discussion in Chapter 6 is going to talk about cash control. And we're going to start with what's called a bank reconciliation. And the bank reconciliation starts with a bank statement. The bank statement gives us information that the bank knows that we don't know about our account. So it tells us the beginning balance, the deposits that have been made, any other additions, credit memos to our account, subtractions for the payment of checks that have cleared, other subtractions that are essentially debit memos. They give us a running balance, and it gives us an ending balance of the account. Now, something to remember about the bank with regards to debits and credits. Now, we know that financial accounting says that the cash account is an asset and it has a normal debit balance. So then why is it that when we get a notice from the bank, if they're reducing our account, they're debiting it, and if they're increasing our account, they're crediting it? That seems to be not right. Well, the reason is that your account with the bank is considered a liability, not an asset. Because if you go into the bank and you want to empty your account, they have to pay you. So since your account to the bank is a liability, and liabilities have a normal credit balance, credits to your account will increase it, debits to your account will decrease it. So here we have an example of a bank statement. You'll notice there's the name of the company, and then across the top we have a summary. This date is the last date of the previous month from the previous statement, 8/31. The balance was 4779.86. There were deposits this month, 5 deposits of $3,571.72. There were 22 checks paid in the amount of $4,537.22. There were other debits of $297.91, and those could be things like charges for the account, that sort of thing. And they resulted in a balance on 9/30, the end of the month for this bank statement, of $3,516.45. You notice this number here at the end, enclosures. Well, it used to be when you had a bank statement, it was mailed to you. It was in a thick envelope, and it had the 3 pages of the statement plus all of the canceled checks that were cleared through your bank account, plus any debit or credit memos. Obviously, we don't get paper anymore because it's too expensive. We just go online and do everything there. Next, you'll notice that there are some columns here. There are checks and debits, so those are reductions in the account. There are deposits and credits. Those are increases to the account. Here's your running balance and the dates of the transactions. Now, when you're doing a bank reconciliation, what you're going to be doing is looking at the cash account and comparing checks in the cash account to the checks that have cleared the bank. Any checks that are on the books, that are on the cash account, that are not showing on the bank statement are called outstanding checks. And we're going to talk about outstanding checks in a minute. Same thing with deposits. We're going to look at each one of the deposits and check them off. Any deposits that are on the books that are not on the bank statement are going to be called deposits in transit. That means deposits that you've put in, but the bank hasn't recorded to your account yet. That's basically what we're doing here on this bank reconciliation. What did the bank know about our cash that we didn't? What did the books know about cash that the bank didn't? So we start the bank reconciliation with what's called the unadjusted bank balance. That's the bank balance, the ending bank balance from the bank statement. We're then going to adjust it for the things that we see on the statement and for the things that are not on the statement, which will then give us what's called the true cash balance. That's how much cash we actually have. So essentially what we're looking at here is that the books are going to have a balance of cash of one number. The bank statement is going to have a balance for cash of a different number. And what we're doing is we're figuring out what's the difference. So we start our bank reconciliation with the unadjusted bank balance. We add those deposits in transit we talked about, deposits that have been made on the books, but they're not showing on the bank yet, and subtracting outstanding checks. Those are checks that have been deducted from the cash account on the books, but haven't been deducted from the checking account. They're saying the same thing I just said. So for the book balance, we're going to do a similar thing. We're going to start with the unadjusted book balance, which means you're going to run a report of the cash account for the month that the statement covers. And that balance is going to actually end rather with a cash balance. We're going to take that cash balance and we're going to add and subtract some things. We're going to add back accounts receivable. So if the bank is making collections for you, or you have your customers sending their checks to your bank, those collections, those checks that were received have not been added to the cash account yet on the books. The bank knows about them, but you don't. So we're going to add those in to the book balance. Then any interest that's been earned that's going to show up on the bank statement that the bank knows about, but you're finding out when you get the statement, you're going to add those interest amounts to the book balance. The subtractions are going to be bank service charges, for example. So if you have typically a commercial bank account, may have a flat amount, a flat fee for the month, plus any checks that had to be processed. And then we're going to subtract NSF checks. And if you're not familiar with what the non-sufficient funds means, it means a check that was written to you, that you deposited in your account, you added it to your cash account on the books, but then when the bank went to redeem that check with the bank that it was written on, the bank that it was written on, your customer's account, the bank said, there's not enough money in the account, we can't pay this check. So the bank will deduct that NSF from your checking account. You have to deduct it from your books. So once we do all these adjustments, we will get a true cash balance, just like we did with the bank. Hopefully, those numbers are going to be the same. And this is describing what we just went through. All right, so if an error is found on the bank statement, so if the bank did something funky, then you're going to adjust the unadjusted bank balance on your bank reconciliation to take that into account. And you're probably also going to get on the phone and call the bank, tell them they screwed up and they need to fix it. If there's a problem or an error made on the books, there's going to have to be an adjusting entry made to correct the amount. So here's our bank rec. As of September 30th, our unadjusted bank balance was $3,516.45. We're going to add in deposits in transit of $724.11. Remember, deposits in transit, those are deposits that we've added to the cash account on the books, but the bank hasn't added it to our checking account yet. It didn't show up on the bank statement. We're then going to adjust the unadjusted bank balance for the bank error. They charged us for a check that was drawn on a different company. The check was drawn on Green Valley Resorts. They charged us, GSRI, for that check. So we're going to add that $25 back and we make that phone call to the bank. And then we're going to have to look, what were the outstanding checks? Well, we had 3 outstanding checks. 639, 646, 672. This goes back to that pre-numbered documents deal that we talked about in internal controls. Total of $235.25. So when we do the math here, we find that our actual or true cash balance is $4,030.31. So now we go to the books, and we're going to do essentially the same kind of a process. We have our unadjusted book balance, which means what's the balance on the cash account on September 30th? Well, the balance was $3,361.22. Now, we had a receivable collected by the bank. These are all things that we got off the bank statement. We're going to add back the receivable for $940. We're going to add back the error that the accountant made on that check that was recorded on the books. It was recorded as $63.45 instead of the actual amount of $36.45. So we need to add $27 back to cash. We're then going to subtract the bank service charges of $8.40. And we're going to subtract the NSF check. And remember, that's a check that we deposited. We added to the cash account and we put it to the bank. The bank, however, couldn't get the cash for it from the bank it was drawn on. So they subtracted it from our checking account. We need now to subtract it from the cash account. And when we do the math here, we have the same $4,030.31. So we have reconciled our checking account. The numbers match. So we actually have $4,030.31. You can see that's significantly different than the balances we started with. And even the balances we started with were different. So now we're not done yet, because the last thing we need to do is record these adjustments to the cash account. If we don't, then the balance stays there. So we need to add these in. So our adjustment number 1, recording the receivable collection, we're going to debit cash for $940 and credit accounts receivable. Adjustment number 2 is going to be correcting for that error on the books. So we're going to debit cash, and because the check 633 was written for utilities expense, we're going to credit the utilities expense account. Adjustment number 3 is going to be recording the service charge from the bank. So we debit an account called bank service charge expense, and we credit cash. And finally is the NSF check. Now when we recorded this check, we debited cash, credited accounts receivable. So now we're going to reverse that. We're going to debit accounts receivable because we're putting the invoice back in to be paid. It's still owed to us. And we're crediting cash because we didn't receive the money for that. Now, if you've ever worked in retail, you know about cash short and over. When using a cash register, employees sometimes make mistakes. And if they make a mistake, either they're going to be over what they're supposed to have, or they're going to be short. In other words, not having enough cash. And that's where we need to adjust for cash short and over and force a balance of the journal entry. Assume a cash register was to have a balance of $487.50 but contained only $486.50 at the end of the day. All right, so we were supposed to have $487. The cash register keeps track of the sales. So from a sales perspective, we needed $487.50, but there's only $486.50 cash in the drawer. So we're $1 short. The way we record that, we're going to record cash at $486.50 because that's what we got. We're going to record $487.50 in sales because that's the amount of sales that were recorded on the cash register. And the difference is going to be a debit to cash short and over for $1. Now we're going to talk about petty cash. Now, if you look up the word petty, it's going to tell you small, insignificant, that sort of thing. And that's really what petty cash is about. Petty cash fund is established to maintain effective control over small cash disbursements, such as postage and delivery charges. Essentially, petty cash is used for things for which there's no time to write a check. The fund is typically established for X amount of dollars. In this case, we're going to be using 300. And it's controlled by the petty cash custodian, which is a great internal control. Because if there are problems with the balance in petty cash, there's one person to go to. Petty cash funds are usually maintained on what's called an impressed basis. What this means is that the money is going to be dispersed over the course of time, and when the petty cash custodian decides there's not enough cash left in the box, they're going to put in a check request with the petty cash vouchers that represent the money that was dispersed, and they'll get a check back for the amount that was dispersed. So at any particular time, the petty cash box is going to have some cash and some petty cash vouchers. But the total will always be, in this case, $300. So establishing the petty cash fund is pretty straightforward. We're going to debit petty cash for 300, credit cash, a simple asset exchange. Now, when the petty cash needs to be replenished, the petty cash custodian is going to put everything together and make a check request. In our case here, the vouchers are postage, $66, delivery charges, $78.40, taxi fares, $28, and supper money, $43.60. There are a lot of places where if the employees work overtime and they're working till 7, 8 o'clock, the company will buy dinner. I did for my employees when we had a closing at the end of a quarter. So we're going to debit postage expense, debit delivery expense, and so forth, and credit cash for $216. That's the check that goes back to the petty cash custodian to replenish the box. So then we have $300 in petty cash again. Now, rarely, but sometimes, petty cash will be over or short, just like it was in the retail situation before. So suppose that a physical count discloses $212.30 in petty cash vouchers and only $87 in currency and coins. Well, if I've got $87 in the box and the petty cash is at 300, I would expect to have $213, not $212.30. So I'm 70 cents short. So a debit, now they're using miscellaneous expense. I would never do that. And if you're going to go into accounting, I suggest you not do it. It's good to, when you have expenses like this, be specific, like we did here. There are accounts for this stuff. Use the accounts. But they're debiting miscellaneous expense. We're going to debit cash short and over for 70 cents. And then credit $213 to replenish the petty cash fund. And that ends our discussion of Chapter 6. As usual, please make sure if you need to talk to me, contact me. I've been doing Zoom meetings with students. I've been doing phone calls. So I'm here to help.